Welcome back to Homebuyer University. Today we're going to talk about loan estimates, or your LE. What is it? When do you get it? And why is it important to you?
So in the mortgage world, we love acronyms. Loan estimate, LE. So you'll probably hear the term LE thrown around quite a bit. And there are usually two times that you can potentially get an LE or a loan estimate. The first time is when you're shopping for a mortgage. So during that pre-approval process, lenders will typically give you an LE. And that LE is there to help estimate costs, rates, and payments that you'd have for your loan approval. The second time, and probably the most important time you'd get that LE or loan estimate, is after you've had your offer accepted. It'll be a part of your initial disclosure package, and it'll be really specific to your property, closing date, purchase price, and all the details of that specific transaction you're now in. So what just is that LE, what's on it, and what do you need to pay attention to, whether you're getting it in the pre-approval or once you have your offer accepted?
Let's talk about what's actually on the loan estimate. So it starts off with your basic information that you need to know about your loan. Your interest rate, your loan amount, your term, type of loan, is it fixed rate or adjustable? Really, it'll give you the core details of the loan that you need to know. So it'll give you a breakdown of all the costs you expect to pay, including all of the total parties involved, and ultimately breaking down your total monthly payment and your total cash out of pocket.
Now, an important thing to know about a loan estimate is it is just that, an estimate. Typically, when you get it in the pre-approval stage, it might be leaving out some core pieces like the right tax prorations or tax rate for the property that you're actually going to be in contract on. So it is a pretty rough estimate. Once you have an offer accepted and you get a much more official loan estimate that's tied to that property, it becomes more specific, but it's still an estimate. As far as some of the specificity to that loan estimate, you'll see that the taxes and prorations are probably much more accurate and honed in than they were on the one you received during your pre-approval. However, in the beginning, there's oftentimes a case where a lot of fees could be overestimated or services included on the loan estimate that you might not actually have to pay for. And there's a reason why.
Typically, these estimates are overquoted. This is a consumer protection mechanism to make sure that you're not underquoted and overcharged at a later date.
So that first loan estimate you get may look high, and it most likely probably is. Talk to your mortgage consultant and they'll be able to guide you through what could be reduced or what could come off. Ultimately, like Andrew said, there is a tendency to overquote in the beginning just in case those services are needed down the line. But as you go through escrow and those services aren't rendered, they cannot charge you for them, and they'll see those be dropped off that estimate as you move closer to closing.
So when you receive your loan estimate, it's important that you take your time, review it, understand it, and if you have any questions, write a list of those questions down and bring them to your mortgage professional. Your mortgage professional is going to go over it in detail with you. They'll explain any variances and any possible fees that might change, but ultimately it's important that you're comfortable and you understand exactly what's on your loan estimate.